Well, look, the US market is important. It's the global equity market setting. It sets the tempo, it sets the investor appetite, and it really sets the direction for portfolio managers. And it's no accident. It's one of the biggest, or it is the biggest equity market in the world. It's the seat of innovation for companies that are looking to raise money for venture capital and the like. It's also the home of some of the world's largest and most successful multinational corporations. It's the seat of capitalism. It's basically where the world's smartest business minds have their securities traded. You have to be aware of that market. It attracts the biggest equity portfolio flows. It's got the biggest retail investment base anywhere in the world. It's important. So monitoring profitability, as we've just done with the third quarter reporting season, is pretty important as a temperature check on just how corporates are travelling internationally and what the potential ramifications might be for Australian companies. The recent reporting season in Q3 was, I guess, a little disappointing. What was obvious from what I could see was that top lines, the revenue equation in a company's result, were contracting, and about 3% contraction was what I think I saw was the average sort of revenue contraction. If you pull healthcare out of that, I think that was the one exception. That then catalysed basically more downgrades and upgrades from what I could see, and you're going to end the year with a negative, probably 2 or 3% EPS growth outlook for calendar 15. That's a far cry from the sort of 10% earnings per share growth that market commentators were expecting. I saw in the Wall Street Journal the other day a reference to the fact that we're seeing an industrial recession underway in the States. Industrial corporations are struggling to grow earnings. You know, Caterpillar and Cummins are two very obvious names that spring to mind who reported terrible results and the market punished them. So there's challenges afoot in corporate America, but they're rising to the occasion. Of interest was the sell-off in August, which was around the time of clearly the reporting season, or just before the reporting season. That lined up with a rejection of the old .com 2000 high on the NASDAQ. So I think there was a bit of a confidence shot. There was also concerns about what the Fed was going to do, and that culminated in some pretty messy price action. But I'm somewhat relieved that as we moved through the reporting season, that US stock market actually rallied and went back almost to the old highs. That's pretty incredible when you've got nothing but bad news coming your way. So I thought that was probably a key takeaway. And right now we have that US market back in that range, and it was a very tight range through a lot of last year, and it's that range, and in fact continued into this year. It's that range that the market fell through, and it's that very range that we're now back into. So I'm somewhat reassured. Equity risk premiums, the proposition of equities versus bonds, earnings yield versus bond yields, in Australia is attractive. I'm pleased to see in the United States it's also quite attractive. The equity risk premium in the United States is around 5% in round numbers. Markets don't tend to peak out. Equity markets don't tend to peak out at equity risk premiums anywhere near as generous as that. Sort of 2.5% historically is where the market's run out of steam. So you've got a number of cross currents happening there. In the Ely Griffiths Group quarterly just recently, we pointed to a few issues. And one issue we did point to, of course, was what was going on in credit markets. And there was concerns building there, which was having a direct influence on equity appetite and equity confidence, centred around the M&A boom that's going on. And there is indeed an M&A boom. Consolidation afoot is happening. We saw a blowout in high yield bonds versus investment grade bonds. So we saw that happening. And we saw an increase in the default rate, especially in the energy sector. Those three elements prompted investors to start to be anxious that are we seeing a credit cycle top? And what does it mean for confidence? What does it mean for bond markets, corporate bonds that is? What does it mean eventually for equities? The fixed interest market or the bond market is always the lead indicator on what goes on in the equities market. You don't want an unhealthy bond market or a high yield market if you are trying to build a bullish case for equity investment. I'm happy to report, having had a quick review myself, circumstances are much different this time versus the last time we were in a credit cycle bind. I see that companies, US corporates, are travelling with much more modest leverage. Net debt to EBITDA levels are much more modest than in previous cycle highs. I see the interest rate coverage, the ability to service your debt is much more comfortable. I see the proportion of double B versus B rated paper it's much higher this time around. In previous credit cycle peaks, you had a lot more B paper versus double B rated paper around. And basically the innovative products we saw last time around, where you had toggle bonds and all sorts of payment in kind type debt structures, which were aplenty, haven't really appeared this time. So I think the credit cycle is not as perilous as was beginning to be factored into stock prices, and I did point to that as being a potential factor in my quarterly. I think the concern for that has somewhat dissipated. I'll point to the valuation argument that PEs in the United States are not as cheap as they were, but they're a long way from being bubble type categories, and the market is just digesting the strength and vigour of the recent reporting season.